On June 17th, 2026, the Federal Reserve did something it hasn't really done before. They held their meeting, they kept interest rates exactly where they were at 3.5 to 3.75%, unanimous vote, 12 to 0. And then, almost as an afterthought, they changed the one thing markets have relied on for the last 15 years. They stopped telling us what comes next. Right now, on the bond market, on the actual futures exchanges where people put real money down, the odds of a rate hike by next year are sitting above 70%. Not a cut, a hike. That's the exact opposite of what every major bank on Wall Street was betting on 12 months ago. So, in this video, I want to walk you through three things: what actually happened at the Fed, why they suddenly went quiet on their own game plan, and what it means for the money sitting in your accounts right now. Hi, my name is Jeff Reed. Hope you're doing well today. Stick around for the finance because I think this is one of the more important shifts we've seen from the Fed in a long time. But stay for the part where I explain why gold and central banks around the world are already acting like they know something the rest of us are only now catching on to. Let's start with the basics because I want everyone watching to actually understand this, not just nod along. The federal funds rate is basically the interest rate the Fed charges banks to borrow money from each other overnight. When that rate goes up, everything downstream gets more expensive. Your mortgage, your car loan, your credit card, business loans, all of it. When it goes down, borrowing gets cheaper and money tends to flow more freely into the economy. Simple enough, right? Now, here's the part most people don't know. Since the 2008 financial crisis, the Fed has done something called forward guidance. Basically, they tell you ahead of time roughly where rates were headed for the next year or two, using something called the dot plot. Literally a chart where each Fed official puts a dot showing where they think rates should be. The whole point of forward guidance was to calm markets down. If everybody knows what's coming, nobody panics. That's what makes June 17th so strange. Kevin Warsh, the new Fed chair, the same guy President Trump reportedly wanted specifically because he was expected to cut rates aggressively, held his press conference. And when reporters pushed him on where rates were headed, he wouldn't say. No forecast, no commitment, just vague language about meeting the data as it comes. That's not normal. That's the Fed going quiet on the one tool that's supposed to keep everyone calm. So let's get into reason number one for why this is happening. The Fed doesn't actually know what to do, and admitting that out loud would spook the very markets they're trying to protect. Look at the numbers. Inflation, measured by the PCE index, the Fed's preferred gauge, is running at 4.1% year over year. Core inflation, which strips out food and energy, just hit 3.4%, the highest reading since October of 2023. That's more than a full point above the Fed's 2% target, and it's not coming down. A lot of it is being driven by energy supply shocks tied to the ongoing conflict in the Middle East. When oil and energy costs spike, that pain ripples through shipping, manufacturing, and eventually your grocery bill. The Fed is stuck. Cut rates to help the job market, and you pour gasoline on inflation that's already too hot. Hold or raise rates to fight inflation, and you risk choking off a slowdown that's already showing up in softer job numbers. There's no clean answer here, and I think that's exactly why Warsh won't commit to one in public. Reason number two, look at what the Fed's own dot plot quietly did. Back in December, the median projection for where rates would land by the end of 2026 was 3.4%. After the June meeting, that median jumped to 3.8%. That's the Fed's own internal forecast moving upward toward higher rates, not lower ones. Multiple Fed officials have started saying the quiet part out loud. Chris Waller, one of the earliest voices pushing for rate cuts, now says he's prepared to vote for hikes if inflation doesn't come down. His exact words, he can no longer rule out rate hikes further down the road if inflation expectations start becoming, in his words, unanchored. When a dove starts talking like a hawk, that tells you something is shifting under the surface. Reason number three, and this is the one that connects directly to your money. The bond market is already pricing all of this in. As of this week, the 10-year Treasury yield is sitting around 4.55%, up from about 4.40% a year ago. The 2-year yield is hovering near 4.2%. Higher yields mean the government has to pay more to borrow, which means more of your tax dollars go toward interest payments instead of anything else. It also means mortgage rates, auto loans, and business credit all get more expensive at exactly the moment household budgets are already stretched thin from inflation. Rising yields with a Fed that won't commit to a direction is, frankly, one of the more uncomfortable combinations the market can be handed. Before I keep going, I do want to mention something quickly, because a lot of you have been asking about this in the comments. We put together a free retirement protection guide that walks through exactly how people are positioning their savings. During periods like this one, where the Fed's next move is genuinely unclear. It's free, there's a link below this video, or you can just scan the QR code on your screen right now if you're watching on mobile. Take 2 minutes, grab it, and keep it as a reference. Okay, anyway, back to it. So now let's zoom out, because this isn't the first time the Fed has faced a moment like this, and history actually gives us a pretty useful lens. Back in 1979, Paul Volcker took over as Fed chair, facing double-digit inflation, and he made a very different choice than what we're seeing now. He was loud about it. He told the country in blunt terms that rates were going up and going up hard, even though it meant a brutal recession. It was painful, but it was clear. What we're watching with Warsh is almost the mirror image. The economic pressures rhyme. High inflation, a Fed behind the curve, a credibility question hanging over the institution. But the response this time is silence instead of a bold declaration. And silence, historically, tends to make markets more nervous, not less, because traders start filling in the blanks themselves. And right now, what they're filling in points toward higher rates for longer. And it's not just Wall Street reading the signals. Central banks around the world are quietly doing something they've almost never done at this scale. According to the World Gold Council's most recent data, central banks bought a net 41 tons of gold in May alone, with Poland and China as the two biggest buyers, 18 tons and 10 tons respectively. Poland alone has accumulated 64 tons so far this year. And in the World Gold Council's 2026 survey of central bank reserve managers, 89% expect global central bank gold holdings to keep rising over the next year, and 74% expect the US dollar's share of global reserves to shrink. Gold has actually now overtaken US Treasuries as the largest reserve asset held by central banks worldwide. Read that again. The institutions that used to park their money in US government debt, the safest asset on earth, are increasingly choosing gold instead. That's not a conspiracy theory. That's published data from the people who track this for a living. Now, gold itself is trading around $4,050 to $4,100 an ounce this week, which is remarkable when you consider where it sat just a few years ago. But the price isn't really the headline here. The headline is the behavior. Central banks aren't buying gold because they think it's trendy. They're buying it because when the institution that sets the price of money in the world's reserve currency goes quiet about its own plan, the smart money starts hedging against uncertainty instead of waiting for clarity that might not come. I also want to take a moment here because this connects directly to something a lot of our viewers have been asking about. If you've got $100,000 or more sitting in a retirement account, a 401k, an IRA, something like that, we're currently offering a completely free one-on-one educational web conference where you can sit down with someone and actually walk through what diversification looks like in an environment like this one. No pressure, no sales pitch, just education. It ties directly into that retirement protection guide I mentioned earlier. Same link, same QR code. All right, let's tie this together. So let me bring all of this back to one place. The Fed held rates steady in June, but it changed something more important than the number itself. It changed how much it's willing to tell you about what comes next. That silence isn't random. It's happening because inflation is stuck above target, because energy shocks are complicating the picture, and because the Fed's own internal forecasts are quietly drifting toward higher rates instead of lower ones. Meanwhile, the bond market is already pricing in that uncertainty through rising yields, and central banks around the world, the people with access to the best information and the longest planning horizons, are responding by buying gold at a pace we haven't seen in years and stepping back from US debt. None of this means your savings are doomed, and I'm not going to sit here and tell you the sky is falling, because that's not what the data says. What it does say is this: the people who run the system are positioning themselves for a world where the old playbook doesn't apply cleanly anymore. The question isn't whether something dramatic happens tomorrow. The question is whether you're paying attention while the people closest to the information are quietly adjusting their own strategy. If you want to understand how to think about protecting what you've built through a period like this, grab that free retirement protection guide using the link below or the QR code on screen. And if you qualify for that free web conference, take the 10 minutes to book it. It costs you nothing, and it might save you a lot of second guessing later. I hope you have a wonderful rest of your day, and I'll see you in the next one.